Hey guys, super happy to be here once again. And today we're having Jonathan Davis. Jonathan, uh, first and foremost, a pleasure to have you here. I told you before we started the recording session that I'm very pleased to have you and that we're going to be having a great conversation. Yeah, how are you today? Before we start the conversation entirely, how do you feel?
Yeah, I feel well. It's great to be having this conversation, and I'm looking forward very much to the discussion with you, Afik.
Brilliant. Thank you for being here. Now, before we're going to be starting the session itself and start diving into the critical questions, I would like to ask for your background. Who are you? Tell more about yourself to the guests and to the audience. Yeah.
I'm an economist by background, and I have over 30 years' experience in financial services. I've worked on the research side, researching fixed income markets. I've worked on the strategy side, setting strategy for portfolios, and I've also been a portfolio manager. So actually taking the final decision as to how to construct the portfolio, communicating that to clients and so on. What I've done is on the macroeconomic side, so I've not been an analyst of individual companies or stocks. I've been looking at things like the direction of interest rates, bond yields, currency movements, and multi-asset strategy. So what proportion should be in equities versus bonds? Do we have any preferences for different regions and so on?
Very interesting. You have mentioned that you are the bridge between the bank and the clients. So you have been responsible for creating that perfect relationship between the clients. I would like to ask you how it's like to interact with a very heavy client background, very conservative type of people. How it's like to interact with them in terms of money conversation and investment conversation because like to my belief that's exactly what's holding that conversation alive in that relationship very well.
Um, as the portfolio manager is has the ultimate responsibility for what goes in the portfolio. I mean, you can have different setups in different asset management firms. So, in some cases, you could have a single strategy, and the portfolio manager is more of an implementer of that strategy. So, then has to communicate what the firm's strategy is. And in other asset management firms, you will have more discretion given to the individual portfolio manager. I think it's very important always to understand what the client expects, what the client's objectives are, what the client is trying to achieve, and what the client's own investment philosophy is. Because if you're an active portfolio manager, what you're saying to the client is, I can deliver better returns to you than if you were merely investing passively. So there has to be some kind of understanding as to how you can achieve that. What is it that you, as the portfolio manager or the asset management firm, can offer that is going to beat the market? I think that the efficient markets hypothesis is a very intuitive. It's a very compelling hypothesis within financial theory. So actually, when an active portfolio manager is making quite a strong statement when she or he says, look, I can actually do better than this. So there has to be some, I think, understanding of how you do that. Or ideally, there should be, because then if you and the client are agreed on this strategy and you're seen to implement it, I think there's going to be more trust in the portfolio manager. If there's no sort of theory or background as to why the portfolio manager expects to outperform the market, then all the client has to do to judge on is past performance. And past performance, I think, is a very poor predictor of what future performance will be. Um, I think obviously over very long periods of time, you need to judge a particular investment strategy by its past performance. But that has to be done over, I think, very considerably long periods of time, and not just over, let's say, the past 12 months.
Mhm. Very interesting. Let's go back to the efficient market hypothesis, and because you say that it's very reliable hypothesis to lay down among the financial markets. And I would like to ask you why, because well, obviously it has a very sustainable background, but sometimes the hypothesis breaks, and I would like to ask you, out of your perspective, how do you manage, or how you saw very successful, very big portfolio managers manage when their hypothesis is broken? So what actions do they take in order to sustain their portfolio and to mitigate and minimize risk?
Well, firstly, I don't think it's necessarily a reliable hypothesis. What I said was it's a compelling hypothesis.
Okay.
The reason it's compelling is you think, well, if there is some piece of information out there which is going to give some indication as to the performance of an individual security or a market, there are so many people examining this information and have an incentive to examine this information. You'd think, well, that information should already be reflected in the price of the security. And there's a joke that I find very amusing about two economists in the from the Chicago School, which was emphasizing the efficient markets hypothesis. And one of them sees a $10 bill on the sidewalk, and he says, "Oh, it's a $10 bill there. I'm going to pick it up." And the other says, "No, don't do that. Somebody will have already picked it up." Um, so it's this kind of thinking which I think makes the efficient markets hypothesis a compelling one. I've been involved in active investment management, so I believe it is possible to beat the market. And I think the other part of your question is what happens when a portfolio manager has a degree of non-performance where he's not succeeding in beating the market. What I've observed is that there are different approaches to try to add extra return, and they seem to go through periods of working very well and other periods where they don't work well. One approach is value investing, where one is using some metrics to try and judge what is the intrinsic value of a security, of a market, and to identify situations where the market price is a long way away from that. Now, what the value investor is essentially saying is, there are certain variables or ratios that will tend to move to an equilibrium level, move to the same level over the long run. So if I can see instances where a ratio is in a, if you want for a better term, a disequilibrium state, that is giving me an investment signal. And one of the reasons I think this can work is that there's uncertainty about what that equilibrium level is, and there's a lot of uncertainty about the market timing of when that will come back to equilibrium. So
Jason, just to clarify,
yeah,
uh, when you're saying an equilibrium, you're actually refining it to a fair value in the market.
yes, I'm trying to elaborate what does it mean to say something's at fair value.
Okay,
So see, you could say,
because
well, this exchange
this is
rate
a
is
very that's obviously a very controversial term to use.
it is a controversial term. So what I'm trying to do is to say, well, what are the assumptions? If somebody talks about something having fair value, what are the assumptions that one is making behind that? So I think what the basic assumption is that there is a tendency for this variable, or probably it's something like a ratio, to move to a given level over time. So we could think of this, for example, in terms of an exchange rate. As long as the conditions are satisfied to give a currency its value, and this means you've got a central bank acting in a financially prudent way. The currency is used for everyday purposes. So there is a belief, an unquestioning belief in the value of that currency. You might say, well, when I take inflation into account, the exchange rate of this currency should fluctuate within certain bands. And maybe if you're a very long way from that, you'd say, well, this is a disequilibrium state. The exchange rate is going to move back towards the sort of equilibrium band at some point in the future. But it's then very difficult to know how long that will take, and whatever it is that's been pushing it away from this sort of long-term equilibrium level may continue to push it away from this long-term equilibrium level. And I think the theory why this approach works is there aren't a sufficient number of investors with sufficient patience to be waiting for that long-term return to equilibrium, as well as the fact that there's uncertainty about what that equilibrium is in the first place. So, I mean, I'm just giving you one example of approach to active investing. When I use the term active, what I mean is you are taking conscious decisions to buy some more, overweight something or underweight something with a view to achieving superior investment returns for your client. Other people believe in things like momentum or trend following models. And again, these things seem to go through periods where they work quite well and other periods where they're not working well. The theory behind why trends should work, I've always struggled with, but the best sort of theory I can come up with is that a lot of the time, financial market prices are being driven by trends, driven by activity, which is not immediately obvious in the data. And if whatever this force that is driving something, if it's getting manifested within market prices slowly over time, then maybe using some kind of trend or momentum technique can pick up that move at an early enough stage so it has further to run. I find this very interesting because it's an even more, if you like, stark contradiction of the efficient markets hypothesis, because essentially what you're trying to do is to make money simply by observing past price information. So, I mean, the claim is, look, I don't even need to know anything about, the fundamentals of the economy or the company or whatever. I can just observe what has been happening to the price and draw some conclusions about what's going to happen in the future. And you'd think, well, if this was so easy, everybody would latch onto that and the price would move instantaneously to where it's going to go. But I've certainly found evidence in the past of this seeming to give positive results, and I'm quite open to the idea that this works as well, that it can be exploited, but it doesn't work all of the time.
Mm-hmm.
Another approach to trying to deliver superior performance often involves essentially taking on more risks. So, I mean, you can do things like saying, well, I'm going to buy higher yielding assets. I'm going to overweight high yielding assets and underweight lower yielding assets, and I'm going to achieve superior performance that way. And
what are the costs and which costs you're going to be taking that you're going to be taking that decision? Because would it take, or would it force you to expand the bands of the equilibrium? Would it force you to inside the equilibrium to understand all of the factors inherently to be able to comprehend what will happen, or to make a further assumption about what cost model you're supposed to work with when you're trying to deploy a certain position or something?
So not quite sure I've understood your question, Afak. Are you relating this to what I would call the carry strategy, which is just to buy overweight high yielding assets and underweight low yielding assets? I mean, a lot of people doing that strategy will perhaps ignore any concept of equilibrium or say, look, I don't think this is a reliable concept. The problem then comes, you get certain situations where these high yielding assets become, from the point of view of somebody who says, well, I think equilibrium is a meaningful concept. I think value is a meaningful concept. They can then become very overvalued and the low yielding ones very undervalued. And when market stress rises, when people are forced to de-risk, it then often means that a strategy that has perhaps been very successful over the past few years suddenly crashes and loses its all performance as people exit these positions.
Mhm. Okay. And let's talk about more situations where you identify a behavior of a portfolio manager, because it makes me very intrigued to understand how they actually reflect their risk or their position or their position in deployment in relation to the equilibrium, and how do they see the picture in a very high space or a very high dimension, so they know how to make the right assumptions.
Well, firstly, as I say, I don't think every investor will necessarily believe in the concept of equilibrium. Secondly, just talking about risk, I think without some idea of some measure of risk, um, you can't really make any investment decisions because you might have a view that market A is going to outperform market B. Therefore, I want to overweight market A versus market B. But without some idea, some measure of risk and some measure of one's risk tolerance or the risk tolerance of the client, you have no idea how to size that position. So having a measure of risk, a concept of risk, is absolutely essential. It could be done in an informal way. I think probably all professional asset managers now will be using fairly sophisticated risk systems to get some idea about what the upside and downside is, and in particular what the downside is in worst case scenarios, and whether that is an acceptable risk to be taking on behalf of the client.
Mhm. That's very interesting. And okay, so let's now dive into portfolio construction, because I think that we need to take, in order to understand the picture entirely. Let's take it a step backwards and talk about the construction. Um, if you see yourself messing with equilibriums, and you understand how you might reflect yourself to risk, and how much exposure will give to certain positions, I want you to talk. I want you to explain more about portfolio construction. How do you think of risk exposure? How do you see it actually correlates with your portfolio entirely, so you would know how to manage it inherently, even if certain hypotheses will be broken, will get broken over time.
Okay. So when we talk about equilibrium, I mean, you could be saying, what is the neutral position of the portfolio? That in itself is quite an interesting question. So very often a client will say, this is my benchmark. This is the neutral position, or you will, perhaps be managing some fund and you will advertise, you say, this is the benchmark. So in that sense, your neutral position is just holding exactly the benchmark, which would be all of the assets that are in the benchmark in proportion to the weights that are in the benchmark. Then there's the equilibrium in the context of the value investment philosophy, to say, well, I think that financial and economic variables will tend towards certain equilibrium ratios over the long run, and I'm using measures of disequilibrium, or misvaluation, if you like, to give me some guide as to whether I have an investment opportunity or not. But you're asking specifically a question about portfolio construction. So you'd then say, well, I have a certain number of perhaps investment ideas in the sense that, I think these ideas are going to generate alpha, which is performance over the benchmark, or it could be that you're simply managing an absolute return portfolio where maybe essentially the benchmark is cash. The question is then, how do you put all of these things together? And here it's important to have a good understanding of the correlations and the volatilities of all these different positions you're taking on. And so if you have a good risk model, you can simulate putting different weights on these different positions to come up with something. What you're trying to do is you're saying, I want to get the highest possible return for a given level of risk that I am taking. I want to maximize the information ratio, or you could put it another way. You could say, well, for this given level of return that I'm aiming for, I want to do this in the lowest risk way. So again, having some idea about the returns from your different strategies and the risks that are inherent with them, they are like two sides of the same coin, or they're like two blades of scissors. You have to have both in order to be able to do portfolio construction.
Mhm. Okay. I'm just thinking about what you're saying. I'm just trying to digest how how it's getting to be a possibility to understand correlations. Now, obviously, we know that the market are very dynamic, and and it's a very chaotic environment by the end of the day. And when you try to sustain or to be in a position for a very long period, you would have to understand the I would say, hidden correlation, or the changing correlation
Yeah,
beneath every position that you're having.
yeah.
And my question to you is, how do you or how you're able to extract this type of information when you're in a position? What type of action do you take if it's a stress test, if you have a value risk systems? How do you use them? How do you utilize them? What they provide you with? Do they provide you with a like a retroactive data, or um, do they give you an accurate real-time understanding of the hidden correlation that you need to take into consideration when you're trying to manage a very not very understandable circumstance?
It's a very interesting question because I think
I
you
was
you
I was
meant
I was trying to ask it very very directly, because
so
it's not
essentially
very
having a view on changing correlations is can very often be the active view, the view you're expressing. You can say, well, I think this correlation is going to change, or it's going to behave differently in the past, and this therefore gives me an idea as to how I can improve the performance of my portfolio. Because as you're hinting, Afek, the models that people are using are, for the most part, based on past data. So they'll be looking and say, well, they estimate correlations based on what the correlations were in the past. Or you'll look at stress tests often based on historical examples of what happened under the periods of stress. I can well imagine that there are more sophisticated risk models where you can actually input your own assumptions about changing correlations. But anyway, when it comes to having an investment view, I think very often thinking about changes in correlations is an important one. And we can just use a topical example. If we look at the way gold and silver are responding now to rises and falls in risk perception, the correlation is very different from how these have behaved in the past, because at the moment, precious metals are behaving like a risky asset. rather than as a something that would holding them would help to de-risk your portfolio. Because in the past, you might say, well, if I'm more worried about war escalating, or if I'm more worried about um, inflation and interest rates, monetary policy being tightened, I'm going to buy some gold. But we're seeing at the moment the correlation has flipped when the market is feeling, when the equity market's feeling more confident, gold seems to be rising in price. So the correlation is not what it was in the past. And then we can dig deeper into that and think, well, why is that? Does gold now have a positive correlation with equities? And I think this then tells us something about what has been driving the price of gold upwards. I think the gold price started to rise a few years ago for quite well-founded reasons, but since then, much more speculative activity has taken hold and has driven the price of gold higher. And I think we're seeing evidence of that in the correlations now we're seeing between gold and the equity market.
Mhm.
But another very important correlation, of course, is the correlation between bonds and equities. At times, this correlation changes. So at times, you'll see a negative correlation when equities are selling off, bonds are rallying, and this occurs when during periods where if you say, well, um, perhaps my expectation of growth of economic strength is deteriorating. That's bad for equities, but it also means that central banks are going to be running lower interest rates, so it's good for bonds. When you get into periods of higher inflation, the correlation often flips around, because what's happening then is you say, well, if inflation's going up, that's bad for equities, and it means that central banks are more likely to have to tighten monetary policy. That's bad for bonds as well. So when it comes to portfolio construction, that is, of a balanced portfolio that contains both equities and bonds, having a good understanding of this particular correlation and how it's likely to evolve in the future is a very important one.
Yeah, but as the efficient market hypothesis says that when equities goes up, the bond market goes down, and conversely.
Well, the efficient
And
markets hypothesis doesn't say that. All the efficient markets hypothesis is saying that um, all the available information should be reflected in the price of a security, which means that, I mean, if this were really true, it should, in theory, mean that nobody is in a position consistently over time to outperform the market. And you might as well just be a passive investor. But of course, there's a contradiction here in the sense that if everybody said, well, I believe in the efficient markets hypothesis, I'm not going to do any research because nothing is going to come of it, I will simply invest passively. Then, of course, if nobody's doing that research, then you're opening up the scope for prices to move away from fundamentals, and therefore you're opening up the possibility for somebody who's going to do the research and think about what are where financial prices should be going given the underlying fundamentals. Then that person can make money. So um, I think there's a sort of, I think the equilibrium point should be that the expected gains from doing your investment research should be approximately equal to the costs of doing that investment research.
Mhm. Very interesting. And let's try to tackle this question from another perspective. Let's talk about stress tests.
Mm-hmm.
Now, obviously, stress testing is like I heard multiple times that there are some quantitative hedge funds that they hire pretty smart graduates from top universities, and what they do is that they give them their hypothesis, and they try to build a reliable stress test upon it. And my question to you, Jonathan, will be, what do you think about stress testing? How you utilize stress testing properly in real time, and how it contradicts to your overall understanding as a portfolio manager, or as an active investment manager. Um, And how do you make your further considerations based on real-time stress testing to understand hidden correlation, to understand hidden market shifts, to understand how the market reflects to your hypothesis as a portfolio manager, and taking all that information into a coherent decision-making process with your portfolio before the market shifts against you, which is a very challenging question to tackle with,
I'm
I
sure
think.
that stress tests are come in a variety of different forms. I mean, I've been used to looking at stress tests which are based on historical examples. So you'd be looking and saying, well, how did prices move during this past episode? So it might be an oil price shock. You could be looking at the crisis that occurred in the Eurozone a little over 10 years ago. Well, it's probably more than that, 2011, 2012. You could be looking at the global financial crisis. And you could then say, well, suppose something like this happened again, what would that do to my portfolio? So that's, I mean, one type of stress test. Or you could be thinking about a hypothetical scenario. It could be something that's not occurred in the past, and you might be thinking, well, how do I think things would behave if this scenario were to come to pass? And you could then build in certain assumptions about correlations and uh, volatilities and so on, and again say, well, under this hypothetical scenario, how would my portfolio behave? I think very often what we're doing with stress tests is we're trying to look at downside risk. So I have my portfolio here. Am I comfortable with the potential underperformance of that portfolio if this scenario occurred? It could be, a repeat, something similar that happened in the past, or it could be a new scenario. I could also imagine situations where people are looking at it from a more positive point of view and saying, well, I think, uh, you know, something new might happen. Um, there might be, let's say, a low probability of that. You might say, well, I think there's a 20% probability of that. Can I construct a portfolio that's actually going to do well under that scenario and is not going to significantly underperform if the alternative, which I think is the 80% probability if it doesn't happen? That might be a more another way to use a stress test. Can I construct a portfolio that's going to do well under some type of hypothetical occurrence in the future?
Mhm. That's look, I think that the work of the portfolio manager is very counterintuitive, but although it's very counterintuitive, and you would have to 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 be activated like for for a majority of the duration when you're managing a portfolio, it is very risky to be counterintuitive in the work. And I want to ask you like about a path or a decision making process or a critical thinking process that you're taking before making a certain move, because the counterintuitively I think plays a major role here in a landscape. I would like to ask you, okay, how you're making yourself secure from, I don't know, false hypothesis or from falsified information, or for any type of risk that you're going to be taking without considering all the pros and cons of taking a certain action.
Um, I'd like to ask you, Afak, why you say being a portfolio manager means being counterintuitive.
Because I do think that you need to be very reflective to everything. You need to take everything um, into proper consideration when it happens, and you would have to be extremely cautious with everything or with every decision that you're intending to take. And yeah, most of the time it would be very intuitive for you to make a decision. But what I was referring to is that you would have to be extremely cautious with your decision-making process before taking a certain decision. And my question to you is, how do you defend yourself from taking a falsified or like a not very considerable risk beforehand? So leverage your how do you leverage your experience in the proper way with your understanding of the current situation in the market? That was my question initially.
I think one of the things you're getting at here is these the decisions one is taking are always decisions under uncertainty. Now, of course, you could be an arbitrager in the strict sense of the word, in which case you're making riskless profit. But I've not been an arbitrager. I've been looking to create superior performance by having what is often we refer to it as being a view. So we think it's more likely than not that this is going to add value. And I think one's got to be cautious in the sense of you've got to strike a balance between being aware that you could be wrong about something, but you've got to have sufficient confidence to implement these views, which are simply views, they're beliefs that you have under uncertainty. You do not know for certain that it is going to work. But if you don't implement decisions based on your analysis, you're never going to add value, and you're therefore going to be disappointing your clients. I mean, if your clients are paying you a fee for active management, you have to deliver that. A client will quite rightly sack you if you simply hug your benchmark, stay very close to it, and never implement any of your active views. So you've got to be cautious in that sense of aware of what might be going wrong, aware that you could be wrong about things, but at the same time, you've got to have sufficient courage to appropriately put on the appropriate amount of risk given the strength of your view. So if you think, well, I think this is I have a very high conviction, I think this is going to work, then you should be using a relatively large amount of your risk budget, if you like. And we talk about risk budgets, like what is the maximum amount of risk you would take? Minimum amount of risk is, of course, zero. And at the same time, if you're in a situation where you say, well, I'm simply not at this moment in time identifying many strategies that I have confidence in, then you should be taking an appropriately small amount of risk. I often think of the challenge to a portfolio manager as being rather like somebody who is playing bridge. Now, in bridge, this is a card game, and if you have a very strong hand, to get the maximum points, you have to commit yourself to making a very high score. So in bridge, you play certain rounds of cards, and you make what are known as tricks. So if you think, well, I think I'm going to make a lot of tricks to get the maximum points, you have to pre-commit yourself to do that, which also means then if you fail to reach that target, you're going to lose points. But if you are cautious in the sense that you do not declare that you have these very strong cards, you are over the long run going to be an unsuccessful bridge player, because other bridge players will be declaring that they have strong cards. So in portfolio management, if you do not take appropriate risk when you have very strong investment signals when your process is saying, I think there is a very high likelihood that I'm going to deliver superior returns. Over the long run, you will then underperform and you'll be failing to meet your client's objectives.
Mhm.
Um, Things go wrong. How do you defend yourself? My own view is that you're in a much better position to defend yourself if you've agreed in advance what your process is, discuss this with your clients and say, well, this is my process, this is how I believe I can add value for you. And of course, no process is foolproof. All processes, all investment philosophies will go through periods of underperformance. I think you are more likely to be able to retain your client's trust after a period of underperformance if you've discussed and shared your investment philosophy with the client and also been honest about what the sort of timing of performance can be expected. In other words, if you say, well, look, I follow this investment philosophy, and if we look at how this has performed in the past, we can see there've been some periods of underperformance, maybe for quite a long period of time, maybe sometimes 2, 3, 4 or 5 years, maybe even longer. But over the long run, it's delivered successful returns. It's added a lot of value, and these are the reasons why I believe it's going to continue to add value. If you've had that kind of discussion with your client, then I think you're more likely to be able to retain the client's trust during a period of underperformance. Um,
Mhm.
of course, it may be appropriate at some times to say, well, I made a mistake about something. Okay. There was something going on here. I hadn't realized that this was important and could be leading to um, this type of behavior in markets. I think also being a portfolio manager is a profession that involves constant learning. We need to be constantly trying to improve the process we have, improve our understanding of how markets work, be aware of things that might be fundamentally changing the behavior of markets. It's work in progress all the time. And again, when we do that as portfolio managers, I think that's something that should also be shared with the client. Probably, it shouldn't involve a 180-degree about turn in your investment philosophy, but we hope that the investment philosophy will evolve and improve over time as we become more experienced, as we understand markets better, and as we are aware of how there might be things out there that are changing the performance of markets, changing correlations, for example, or changing the likely expected returns.
Mhm. That's look, I would like to tackle a point that you were mentioning, which is retaining a customer or retaining an accredited investor, um, which is, as you have mentioned, that's a profession that you absorb over time. And I want to talk about a step before it, and I want to ask you as a portfolio manager that aims to provide like a very specific yield or a very specific exposure to a certain asset classes for an investor, I would like to ask you, how do you develop a relationship and how do you create enough credibility with an accredited investor, for example, um, before they decide to move on and to invest within your fund.
Um, so normally, an asset manager will come to an investor with some kind of investment proposition, which would include, well, in my view, should include the investment philosophy, your basic investment process. So you'll be providing a lot of information about the resources that you have as a firm. So how many analysts you have, how many strategists do you have, What is the committee structure? How do you implement positions? So how do you um, actually change the positions in portfolios? Who does that? What your execution desk does. The investment philosophy part should be part of this pitch. And then I think it's the first question will be, does a potential client find this intuitively appealing? Does it accord with the investor's beliefs? Does it make sense? Does the investor think, yeah, actually, I like that, but I think this is a process that can work. I want to buy into that. I think that's in my view is the ideal situation where you've already come across some kind of um, rapport in terms of your belief about how markets work. Now, if that is not there, an investor might just be saying, well, I'm looking for a reliable asset manager, somebody who has a good reputation, and the investor might think, well, okay, the track record looks pretty good and has a good name. I'm going to put my money with that asset manager. I think I've been saying, I think the asset manager then goes through a period of underperformance, the investor has less reason to say, well, actually, I'm going to stay with this manager because I believe this is going to turn around, than if you've got some prior understanding between the two of you, the two sides, the asset manager and the investor, as to what drives markets and why the existing approach is likely to deliver superior performance in the future, even if it's perhaps not met the return targets in the recent past.
Mhm.
And of course, the relationship between an asset manager and an investor is an ongoing one. I mean, normally you'll be having regular dialogues with the investor. Certainly, the investor will be seeing your performance figures and probably performance attribution. What generated these returns? What positions did you have were successful? What actually detracted from performance? And all of these are um, um, topics for discussion at your meetings with the client, where hopefully that is going to give you the opportunity to deepen the rapport, the understanding between the two sides.
I understand. Um, I would like to go back into the discussion, the ongoing discussion with the investor, and I would like to ask you about how to present properly those performance figures. What are the rightest approach to provide with the performance figures, and to still be sure to keep the relationship very alive and very healthy?
Well, performance figures have to be presented accurately and in line with industry standards. So,
How
I mean,
frequent?
well, normally quarterly, or they could even be more frequent than that. The investor may be seeing them on a monthly basis, maybe even on a daily basis. I mean, if you're managing a fund that has daily pricing, the investor will be seeing it every day. So this is not something that's really up for debate. The performance figures have to be accurately displayed, and attribution has to be done in a clear way that is understandable by the client in accordance with industry standards.
Mhm.
So the discussion about what has been generating the views that you had, these are then something that the reasons you had these positions on in the first place are things that can then be discussed by the asset manager, by the portfolio manager. Um, whether something has turned out the way the asset management expected, or whether it's not turned out the way the asset manager expected. These conversations can then be had with the client. And I think very importantly is to say, well, okay, because all performance figures are essentially backward looking. What is my strategy now? What is my view now? Why am I positioned the way I am now? What do I expect to happen?
Let's talk about position, position sizing, and internal risk management. Um, when you're having a very diversified portfolio and you know that you are working with a very distinct level of investors, and they obviously have agreed to your proposition as a fund and to your proposition as a PM. I want to understand if you have cash, how do you think of, I would not. I would say that increasing your exposure, strengthen a certain position. How do you consider risk management in a certain way when you have another wave of investment coming in? So you have more money to invest in. You have more money to even increase your exposure and to increase your diversity among your portfolio. So I want to understand what is the exact chain of thought or considerations that you're taking when you're having like a great wave of new cash coming in or cash that you have out. How do you think about capital deployment, and what are the consequences that you expect when you think of a certain capital deployment?
If one's views haven't changed and cash is coming in, then the
Well,
ideally,
first of all, congratulations.
yeah, okay, so congratulations. But then I think one would first think about just increasing all the existing position sizes proportionate to the cash inflow. And similarly, when cash is going out, you decrease them proportionately. Now, the interesting issue arises when you hold illiquid positions, when it's going to be costing you money to buy or sell positions in certain securities. And then what can happen is that your asset allocation becomes a little bit distorted by these cash inflows and outflows, because you might say, well, I've got this big inflow. If I want to invest more in this liquid stock, it's going to be difficult. It's going to be expensive. So I'll just buy more of the liquid stock. So that then changes your asset allocation. The problem is, I think, more often occurs when money's flowing out. The portfolio manager has demands to hand back cash, and the easiest thing is to sell the more liquid parts of the portfolio. That means that if you're managing a fund and maybe you've got some clients just withdrawing their holdings of that fund, the remaining clients then are getting a different asset allocation with a bigger weight to illiquid stocks. So that is, I think, is a challenge. Fortunately for me,
Well,
it's never a
understand.
challenge that I've had, because I've always been managing liquid public markets. But it's something that we read about a lot in the press, where there've been outflows from particular funds, and it may be difficult for the fund manager to realize the proceeds from less liquid holdings. And of course, when we're dealing with things like private markets, very often, or say real estate funds, the fund manager can say, well, I can put restrictions on the outflows. You may only withdraw a certain amount over a quarter. But in fact, I think maybe your question was more about, how does a portfolio manager decide on new investments if money's coming in? So
Yeah, more or less. Well, obviously, he can take a direction where he decides to increase or decrease a position in proportion, in direct proportion to the new money coming in. But if he wants to increase the diversity, and if he wants to deploy capital into a certain asset class that he wasn't really exposed to previously, what actions does he consider
it
before committing into
it might
such a
be
move?
a convenient opportunity. So if we're talking about a cash inflow, it might be a convenient opportunity to buy something that was not previously held in the portfolio. Because, I mean, any change in positions is involving some kind of transaction cost. So if you've got money coming in, I mean, it may be the difference between saying, well, um, I have my portfolio and it has this construction at the moment. I'm perhaps interested in buying into this new market, this new security or whatever it is. But it means I have to sell something else. So I've got the transaction costs of selling something and the transaction costs of buying it. If money is then coming in, that means you can perhaps avoid the transaction costs associated with selling something. So that might just be the the difference that makes it worthwhile adding a new position to the portfolio, which you would have not done without the inflow.
Mhm. That's a very convenient situation, obviously. But although it's although it's conveniency, I would like to say that, or to brainstorm together with you, that it might not be that convenient as we expected, because we have certain restrictions. So you have mentioned that you were managing public markets, very liquid assets. So you are able to liquidate your position in a matter of minutes to hours. Fix me if I'm wrong, by the way. Um, and what happens if you are not exposed to such liquid markets? And what happens if your thesis as a as a portfolio manager will be to sustain yourself for larger durations and to increase positions with less tradable instruments? So that would be a little bit challenging to tackle, because that way or another, you would have to think about risk management in another proportion. So the term of the asset class will impact your decision process very much. Then that's what I feel. Than a liquid public market.
Well, I think that's a very fair point. So if you say, well,
No, please fix me if I'm wrong. I'm trying to take it a step further into that conversation. So it might not be the rightest step, you know.
no, but okay, so what we're talking about now is portfolios that hold illiquid assets. So assets that uh, might be very costly to sell at short notice.
Mhm.
So, I mean, ideally, these are assets that, when you do eventually come to sell them, these will be in favorable market conditions, and you'll want to be able to take your time to make sure you're getting the best possible price for these assets. Um, there may even be assets that, in some sense, mature. I mean, it might be some kind of private loan, for example, that is going to be repaid on a specific date in the future. And if you then want to realize that asset now, in other words, you want to pass it on to somebody else, that may be difficult to do. So, uh, as I say, this is not a challenge that I had as a portfolio manager because I was not managing illiquid assets. But I think your point that the portfolio manager needs to take this into account and think, what if I got redemptions or outflows? Um, Under that scenario, what that do to my asset allocation? I might be forced to sell more liquid assets first, resulting in an increase in the proportion of these illiquid assets in my portfolio. And I think that's a reason to be a little bit more cautious about perhaps having a large proportion of illiquid assets in the portfolio. Um, I'm assuming that this is part of the portfolio manager's benchmark, so it's something he's expected to have, or she's expected to have. Um, and very often, the reason for holding these types of assets is because they have a higher, longer term expected return. So these are things you say, well, I'm holding these for the long term. They're going to deliver superior returns than my more liquid assets. My more liquid assets are something that can be bought and sold quickly. The exact proportions of the holdings is going to be some kind of trade-off between your longer term expected returns and the need perhaps under certain circumstances to be raising cash quite quickly, perhaps for some demands from your clients. And this whole question then has to be integrated into the agreement about the circumstances in which your clients are allowed to withdraw money, how much they're allowed to withdraw, over what periods, and so on. All of this, I think, should be considered together.
Mhm. That's a very interesting point because illiquid to illiquid, I think that there is this distinct differentiation between how to approach them with a better proportion to the characteristic of the asset classes. Because as you have just mentioned, it is just a different language. I think that's that's I think that's a fair proposition to put it. Now, I would like to tackle the last topic for today's conversation with you, which is about fundraising, which is the thing that I think that we haven't really touched upon. So, as an independent portfolio manager or as a small fund, you obviously have I think harder experience in fundraising, and I want you to explain me how it looks like raising funds from investors, how to interact with those investors, how to create that a certain credibility between both of the parties, so they can proceed to the next step. Um, and how in general that bureaucracy is actually happening in between after a decision to move forward. And yeah, just I want you to describe the process to the process entirely, so we will be able to get much more familiar with it.
Well, I have not so far tried to raise money from the perspective of a small firm. I have worked for a large firm for all of my career where we had uh, skilled departments promoting the services that we're able to offer and able to go out and market to clients, and of course had the reputation of being a very large fund manager with also a very good reputation. Um, I think that there are a lot of challenges if you are a small fund and you're trying to raise money. Um, I, how one does that, I could imagine somehow maybe you need to get some kind of sponsor or backer, somebody who believes in what you're doing. I think that above a critical size of assets under management, it then starts to become easier to raise funds. So what you're hinting at, Afak, that um, if you're a sort of small startup or a small portfolio manager, that it's very challenging to raise funds. I completely agree. I think it is very challenging, and uh, that's not to say it can't be done, because obviously people do succeed, and uh, can one can end up being very successful. It's not something I've done so far. If it's something I end up doing in the future, I'll be very happy to discuss my experiences with you.
So yeah, we'll get on
Yeah,
to part B of the
yeah.
podcast. But I will say that it's very intriguing process to see how a small fund raises money, to see its difficulties, to see how they propose their edge, um, how they propose themselves to clients, and how they reflect themselves to a definitive alpha that they can actually sell as a very self-explanatory product to their investors. Well, Jonathan, I would love to thank you for the conversation. For me, it was very educative talk, because I would say that I would be frank and honest here. I really had the chance to interview here a portfolio manager from your perspective, or any portfolio manager at all, and I'm very very happy for the opportunity to have you. And I think that the value that you have shared with us today was very unique in many terms, because it was very much the opposite from quantitative research, but a very reliable understanding of how the relationship and the transaction in between clients and portfolio managers, and how they interact with each other, and how a portfolio manager, a small fund, is supposed to interact with their portfolio, and how to interact in every position, and how to look at the things properly. So I very appreciate your time, and I very appreciate your insights. And yeah, thank you for coming. It was a privilege.
It was a pleasure, Afek, and thank you for your very insightful questions and being able to steer this dialogue along such interesting paths. I very much enjoyed discussing things with you, and look forward to
I
staying in
appreciate it,
touch.
obviously. So everybody, till next time. Bye bye.
Okay, thank you. Bye bye.